and welcome to the Divorce Lab. We're a group of independent professionals working to help educate the public on various topics related to divorce. I am Carrie Goldring, a certified divorce lending professional who specializes in mortgage planning.
And I'm Mark Avezai. I'm a certified divorce financial analyst. I work primarily in Troy, Michigan.
Hi, I'm Jim Chryssikos. I'm a family law attorney and mediator located in Troy, Michigan. So let's get started with today's show.
Well, we are welcoming Ben Bershad again, and we are going to go we're going to deep dive a little bit onto one specific topic about the perspective from someone who owns a business or is a spouse of someone who owns a business, and how you evaluate the business as an asset and also how it's evaluated as an income. So Ben, we welcome you back.
Thank you. It's good to be back. I've been doing what I do now for about 20 years, and understanding income is one of the last things that I think somebody in my position in my field truly understands. There's so much that goes into it. And I was thinking, as I was kind of getting in the right headspace for today, what one way to sort of sum it all up. And I was thinking about the movie Grease. Have you guys seen Grease?
The musical? Sure.
Yep. So the end, they've got their cars. They finished, getting all the cars ready for the race, and they're down at Thunder Road. And the bad guy, Scorpion, who's going to be driving, says, the rules are there ain't no rules. And that's kind of what it's like when we're dealing with income for support. Is the rules are very broad. There are many factors depending on what type of income you're looking for and what you're doing with it. And every rule that somebody tells you, here's something that you look at, there's always an exception when you don't do that, depending on the circumstances. So I'll let that be my introduction, and we can kind of take it from there.
I like it. And then obviously there's a million and one different types of businesses. And I don't know if it makes a difference to you if someone files as a Schedule C, or partnership, a corporation. But can you maybe talk about, let's just start with the asset part of the business and why you would be evaluating a business as what it's worth, and does it matter those three types of tax returns being filed?
Generally, what I get brought in to do is one of a few different things. One of them is put a value on a business, so that business can then go on the net worth statement, or what I call the marital balance sheet, for division purposes. Somebody gets a house, somebody gets a business, somebody gets the cash account, somebody gets a 401k, and then at the end of the day, someone's got more than the other one, and that has to be equalized. So for purposes of a lot of what I do is business valuation and trying to figure out what the businesses are worth so we can put them on the balance sheet like that. As part of that process, a lot of times we're looking at the cash flow or income that the businesses generate, and we use that in one of our main approaches to determining valuation. We use that income during that process. And so it's relevant for the valuation, but it's also relevant if we've got parties that somebody is going to be paying child support or alimony, also known as spousal support. And one of the kind of the big things that we talk about a lot is there can be a difference in the income that is used for child support versus spousal support, especially when you've got a business involved. It's a very broad topic, and we could spend the entire afternoon talking about it, but I'll try to sort of tiptoe around the biggest issues. You asked me another part to that question, and which was, does it matter if it's an S corp, a C corp, or an LLC? And it does and it doesn't. You just have to be looking for different things depending on how it's reporting. So a C corporation is for our watchers and listeners and viewers at home, is a corporation that is set up like a public company would be set up, where the company makes money. The company pays taxes on that money from the company directly to the state and federal government. And then in order to get the money out of the business, then the company either pays compensation, W-2 compensation to the owner, or pays dividends. And then the owner has to pay taxes on either the W-2 comp or the dividends. So that's why a lot of people don't like to incorporate as a C corporation, because you have to pay taxes twice, once at the corporate level and then once again at the personal level. The alternatives to that are having an S corporation or an LLC, where the corporation themselves, the company, doesn't pay the taxes. The individual recognizes the income on their own personal tax return, and then they pay the taxes based on their own personal rates and their own, personal tax situation that their CPA helps them out with. So at the end of the day, the income, could be the same depending on if they're a S corporation. And, if everything else is equal and it's just a matter of how are they organized or incorporated, it might be the same. It might not, though. And we're going to be looking at different documents. The tax returns are going to be a little bit different. The tax situation is going to be a little bit different, depending on how the business is organized or incorporated.
So Ben, let me ask you a question. Take a hypothetical where you have, let's say it's a medical practice, and I'm representing the spouse of the owner of that medical practice. And we send out discovery in a divorce case, and it comes back in, and it turns out this is a C corp. The owner spouse, he pays himself a salary. He pays his office assistants a salary, his couple other employees, and he says, "That's my income. I pay myself a salary. I pay myself $150,000 a year. That's what I make. That's what you should be using for child support calculations. That's what you should be using for spousal support." So that's a starting point. And that's not an uncommon starting point. And we pass that information. Let's say you're our expert in the case, and we say, "All right, what do you think about this?" And obviously, we're going to need some tax returns for both the C corp and personal. But where do you go from there?
So, and I have this discussion all the time with clients, is the tax returns are always the starting point. It's always, it's the foundation. And I more often have that discussion when somebody tells me, "Oh, this guy hasn't filed tax returns, since the Reagan administration." And then you've got a problem, because that's the building block. I mean, that's the foundation. And where do you start if not from the tax return? So maybe that person is right. Maybe all he makes is 150 grand. Maybe that's true. But there are other buckets of income that we have to at least consider and look for, other than wages. You have to look for, if it's a C corporation, he might be paying himself dividends. Most people don't, because then you have to pay taxes a second time. But he might be paying himself dividends, and you have to look on the tax return, and it'll show if there are dividends being paid. But the biggest thing you have to look for with a business owner is perks, because most business owners have some type of perks. It can be small. It can be their cell phone, and it's $100 a month, and that's it. But I've seen some pretty ridiculous things that people will run through their businesses. I've seen, they've completely renovated their home or rebuilt a home, and they put $200,000 of business expenses on the tax return. Vacations, family vacations, every meal that they ever eat, everything they buy on Amazon, everything they buy from Costco, and all that stuff falls under the umbrella of perks. And my understanding of our case law and our Michigan Child Support Formula Manual is that those perks are fair game for support compensation. So when I say support compensation, it can be either alimony, spousal support compensation, or child support compensation that we use to derive what the support amount should be. And all of those perk things are fair game to include. And it might be that the doctor doesn't take anything. His books are completely clean. He pays no personal items. He pays no dividends to himself. The only financial benefit that he has from the practice is his W-2. And if that's the case, his income is 150. But we have to at least consider those other things, because in more cases than not, there are those other things to some degree.
Thank you for listening to us today. You can find us on the divorcelab.com. You can feel free to take a look at our other episodes, and you can also leave some questions or comments for us on there as well.